Yes, I think on the oil markets, we expect a lower geopolitical risk premium in our base case because the military action, and we see that probably the escalation might not be what the sort of market was fearing. So we have sort of put our base case scenario with a lower geopolitical premium. Again, because in 2025 we are looking at more of a surplus scenario because the demand seems to be a bit weak, especially from China. We have seen the fiscal stimulus from China, but we do not expect that kind of growth in the demand that we expected. So we might see a weakening in the oil prices.
Okay, so perhaps a further weakening to come. Faisal, just with regards to the investment strategy here, how are you managing risks associated with the regional conflict? And what does this all mean for a portfolio or a basket of risk assets moving forward?
I think there are a lot of data points that are going to come as you on the short term. We are looking at the jobs data, the inflation data, and elections in US is a very important sort of event. But we might see, especially on the risk on asset, we might see a short term rally after the election results if they are called early. That because we believe that markets don't like uncertainty. But yes, any delay in calling the elections, we might see a kind of a decline in the market. But overall, post-election, we see that there might be an inflationary sort of a trend which might affect the Fed and the interest rate trends. So we are sort of rotating from cash to fixed income now that we are more or less certain about the interest rate trends in the fixed income markets.